Imagine this. You've just lost your job. Bills are piling up, and your savings account barely covers next week's groceries. What do? An emergency fund can mean the difference between surviving a financial storm or being swept away. But how do you decide how much to save? Let's break it down. How do you calculate your baseline expenses? What factors should shape the size of your fund? And where should you stash it so it's always ready when you need it most? By the end, you'll know exactly how to create an emergency fund tailored to your life, one that gives you peace of mind and financial resilience. How much should you save? The amount you should save for an emergency fund depends on your specific circumstances. Here's a breakdown to guide you. 3 months of expenses. If you have a stable job in a growing industry, low monthly expenses relative to your income, or other sources of income, like a spouse's salary or rental income, 3 months' worth of expenses could be enough. This is especially true if you feel confident that you could quickly find a new job or generate income if needed. 6 months of expenses. If you're in a more volatile field or have fewer assets or job security, it's safer to save up to 6 months of expenses. This is also a good choice if you don't have additional income sources, like a partner's salary, to rely on, or if your job search might take longer due to a competitive or slow-moving industry. 9 to 12 months of expenses. In cases where job security is particularly low, or if your income is highly irregular, saving 9 to 12 months could give you the breathing room you need. This is often recommended for freelancers, contractors, or those working in declining industries. Many people, myself included, often overlook properly calculating essential expenses. However, the correct approach involves considering all aspects of living costs. Start by calculating essential expenses like housing, utilities, and transportation. Next, assess discretionary spending, such as entertainment and dining. Don't forget to factor in job search costs, like transportation, as well as other mandatory payments like tuition or taxes. Adjust based on your situation. If you have substantial savings or investments, if you have a solid portfolio or liquid assets, such as stocks, bonds, or a well-funded emergency fund in investments that can be quickly liquidated, you may be able to adjust the amount down slightly. Just ensure that your emergency fund is accessible without too much hassle or financial penalty. If you have secondary income, if you have a part-time job, side hustle, or any other reliable sources of income, you might be able to reduce the amount you save for emergencies. Storing your emergency fund. Reallocate a portion of your emergency fund to a local bank, as there are situations where even a one-day delay in accessing your money can be costly. To ensure easy access, consider reliable options that offer daily liquidity, such as a savings account. Additionally, investing part of your fund in treasury bills can provide maximum security, a reasonable return, and scheduled access to your funds when needed. When is an emergency fund not needed? An emergency fund might not be as critical if you're in a stable financial situation. For example, if you have significant investments generating passive income, or if you're already debt-free and financially secure, you may be able to rely on these resources instead. However, even in these cases, having a small emergency fund can still be beneficial for covering minor surprises, such as an unexpected charge or a delay in income.